You hear it everywhere you turn, on the news, at the coffee shop, even whispered amongst your family. Interest rates are going up. For many, it feels like a mystery, a financial force beyond our control. But understanding interest rates and their impact on your hard-earned money is crucial, especially in today's economic climate. Whether you're a seasoned investor or just starting, knowing how interest rates affect your investments can mean the difference between reaching your financial goals and falling short. It's about protecting your future and making your money work as hard as you do. So, let's break it down together, step by step. Let's demystify interest rates and empower you to make smart financial decisions, no matter what the market throws your way. In simplest terms, an interest rate is like a rental fee for money. It's the cost you pay for borrowing someone else's money, or the reward you get for lending yours. When you borrow money, you pay interest to the lender. This is the lender's way of making a profit from the transaction. When you save money, you earn interest from the bank. This is the bank's way of compensating you for letting them use your money. Think of it as a reward for letting them use your money. The more you save, the more you earn in interest over time. Interest rates are influenced by many factors, but the big one is inflation. Inflation erodes the purchasing power of money, so lenders demand higher interest rates to compensate. When prices rise, interest rates usually follow suit. This is because lenders need to ensure they are not losing money in real terms. The Federal Reserve, or the Fed, sets a key interest rate that influences all others. This rate is a critical tool for managing the economy. This rate impacts everything from mortgages and car loans to the returns on your savings account and investments. It affects how much you pay or earn in interest. Why should you care? Because rising interest rates have a ripple effect across the entire economy, impacting your borrowing costs, savings growth, and how your investments perform. They can influence everything from the cost of your mortgage to the return on your savings. Understanding these dynamics gives you the power to make informed decisions about your financial future. By knowing how interest rates work, you can better plan your finances and make smarter choices. The stock market can be a bit of a wild ride, especially when interest rates start to climb. Here's the thing: when interest rates rise, borrowing money becomes more expensive for companies. This can cut into their profits, making investors a bit wary. High-growth tech companies in particular often rely heavily on borrowed money to fuel their expansion. Rising interest rates can squeeze their margins and impact their stock prices. On the flip side, some sectors like the banking industry actually benefit from rising interest rates. Banks can charge higher interest on loans, potentially boosting their profits. The stock market is complex, and predicting its every move is impossible. Remember, diversification is key. Don't put all your eggs in one basket. Spreading your investments across different sectors can help cushion the blow of market fluctuations. Bonds are often seen as the safe haven, the more stable sibling to the volatile stock market, but even bonds aren't immune to the effects of rising interest rates. Here's the deal. When you buy a bond, you're essentially lending money to a government or corporation. In return, they promise to pay you back the principal amount plus a fixed interest rate over a set period. Now, when interest rates in the broader market increase, newly issued bonds become more attractive because they offer higher returns. This makes existing bonds with lower interest rates less appealing, causing their prices to fall. It sounds scary, but there's a silver lining. If you hold on to a bond until maturity, you'll still receive the original principal back. Plus, you can reinvest those funds in newer bonds with potentially higher interest rates. Real estate, often considered a tangible and stable investment, also feels the heat when interest rates rise. This is because higher interest rates can significantly impact the affordability of mortgages. Higher interest rates translate to higher mortgage rates, making it more expensive to buy a home. As a result, potential buyers may find themselves priced out of the market, leading to fewer home sales. This can cool down the housing market, potentially slowing down price growth. Sellers might have to adjust their expectations and be prepared for longer listing times. Now let's talk about alternative investments like gold and cryptocurrencies. These assets often come into focus during times of economic uncertainty. Gold, historically seen as a hedge against inflation, can sometimes hold its value or even appreciate during periods of rising interest rates. Investors often turn to gold as a safe haven. However, its performance is not guaranteed and is subject to other market forces. Factors such as geopolitical events and changes in supply and demand can also influence gold prices. Cryptocurrencies, known for their volatility, are a different beast altogether. Their value can swing wildly in short periods, making them a high-risk, high-reward investment. Their relationship with interest rates is complex and still evolving. Unlike traditional assets, cryptocurrencies are influenced by a myriad of factors, including technological advancements and regulatory changes. The key takeaway? Diversification is your best friend. By spreading your investments across different asset classes, you can mitigate risks and potentially enhance returns. Don't put all your faith in a single asset class. Diversifying your portfolio helps protect against market volatility and unexpected downturns. Spread your risk and consider consulting with a financial advisor to create a portfolio that aligns with your risk tolerance and financial goals. A well-balanced portfolio can provide stability and growth over the long term. So, how can you protect your hard-earned money and even thrive in a rising interest rate environment? It's a question many are asking as the financial landscape shifts. Here are some practical tips to help you navigate these changes effectively. Review your budget. Take a close look at your spending and identify areas where you can cut back. This might include dining out less, canceling unused subscriptions, or finding more affordable alternatives for everyday expenses. This will free up cash to invest and take advantage of higher interest rates on savings accounts. Building a solid emergency fund is also crucial during uncertain times. Consider high-yield savings accounts and CDs. These financial products offer higher interest rates than traditional savings accounts, allowing your money to grow faster over time. It's a smart way to make your savings work harder for you. Revisit your debt. If you have high-interest debt, like credit card balances, prioritize paying them down. Reducing debt can significantly improve your financial health. Rising interest rates can make these debts even more costly, so it's wise to tackle them head-on. Stay invested. Don't panic and sell off your investments based solely on interest rate movements. Market fluctuations are normal, and staying the course is often the best strategy. Remember, investing is a long-term game. Patience and consistency are key. Diversify your portfolio. Spread your investments across different asset classes to reduce risk. Diversification can help protect your portfolio from market volatility. This strategy ensures that you're not overly reliant on any single investment. Keep an eye on inflation. Inflation erodes purchasing power, so it's crucial to monitor its impact on your investments. Adjust your strategy as needed to stay ahead. Consult with a financial advisor. A qualified financial advisor can provide personalized guidance tailored to your specific financial situation and goals. They can help you navigate complex financial decisions and create a plan that aligns with your objectives. With the right strategies and support, you can confidently face the challenges of a changing financial landscape, tailored to your specific financial situation and goals. Navigating the world of finance can feel overwhelming, especially with the constant buzz of rising interest rates. But remember, knowledge is power. By understanding the fundamentals of interest rates and how they impact different investments, you can make informed decisions and protect your financial well-being. Stay informed, stay engaged, and don't be afraid to ask questions. Your financial future is worth it.